Welcome to the GTU. My name is Barry Holmes. This module is going to be on share price cycles and how that's related to expiration financing. Now, everybody has had cautionary statements, but I'm not a public company. My company is Avitera Capital. I do contract to a public company out there called Teuton Resources. But in this respect, I'm representing Avitera. And I don't need to put up a cautionary statement, but I would tell you what you hear from me, you want to consult with your financial advisor over, because the information I give may at times be aggressively forward-looking. What we're going to look at is analyzing and de-risking your investment risk in relation to the orphan phase of a stock cycle. So what we're looking at is what is called the life cycle of a junior resource company, and that is based on older business cycles that were created in the past, and those cycles were created out of the psychology of investors or buyers of retail in how it reflects on innovation and new ideas coming up. So this is the business cycle. When you start something, everybody gets excited, it peaks, then there's a contraction phase as it rolls back down to a trough, and then they get better ways of marketing, they increase production, whatever it happens to be, and things start to go on the upside again with increased production, increased profits, whatever it may be, depending on whatever business it is. But that is a really old theory, and it tends to play out in a lot of different situations. So when you look at it again, redrawn in a different application, they're just talking about how you have expectations of something becoming of value along the bottom line, which is the timeline of maturity of that product. So if you got the brand new mousetrap, everybody's going to be excited. People want to buy it. People want to invest in it. And it goes through the excitement phase. And then it kind of peaks. And then you got competition coming in, whatever it may be. But in a business cycle, it would come back down in value. And then it would stabilize on maybe an upward trend or some kind of plateau that represents the value of that business. This drawing was made in relation to the cycle of 3D printers. So at the bottom left, you have the innovation happening, and then you have kind of the geeks that are really tracking that type of innovation. So they're early adapters, early buyers. As things start to progress, you will get a lot more investors coming in, seeing the potential, and it goes through the excitement phase of expectations, peaks out. Maybe the market gets flooded. Depends how it unwinds and what type of business it is, but it will start to descend down the backside and then go through that trough of disillusionment, and then as you weed out competitors with inferior product, whatever the case may be, it will start to mature and grow in value that is realistic to the actual value of what that product is. So this is one of the early charts that came out called Life Cycle of the Junior Explorer. So on the bottom left it says discovery, but as you see, that line goes along flat before the discovery, and that's where a lot of people are buying shares in a company in the hope that it will make a discovery. But statistically, that is unlikely. But if you're fortunate enough to be part of that discovery, it's pretty exciting. There's no doubt about that. So what you have is a discovery is made, then the speculators jump in. There's always talks of possible takeover. But this is the flurry of excitement where investors in, and stock price will rise, and then something happens. Who knows, maybe the news isn't good, or can't extend the discovery hole. and you get that pulled back, and you've gone from high risk down to low risk, supposedly, and then institutional investment comes in. It's going to proceed to become a mine, and you go up to full value. Very rare. Once again, this is life cycle of a junior explorer with a little bit more added to it. So it's chugging along on the bottom left there, and then they get an exciting hole. All the rainbow chasers jump in, fear of missing out types jump in, and you get a big rise in the stock. You go through a high risk, high return phase there, if you should sell. A lot of people will sell some and hang on, whatever strategy they happen to have, but they'll go over the top. Speculators start to pull out. Stock comes down rather quickly on little volume, and then it hits that bottom trough, which is known as the orphan period. The orphan period is a great opportunity in the right circumstances for an investor to accumulate shares. It is not totally de-risk, and as you can see at the question mark, is there are certain things that have to happen to de-risk this opportunity, otherwise it could go even lower. But if it starts to prove out in the way that it should, you will start to see more serious investment come in there. Price would start to rise, institutional investors would come in, and you're headed off towards full value. This is a stock I studied back in 2011, and I was working for a company, and they wanted to know, can we follow that path? What do we need to do? What do we need to produce to get there? And this was a project in Colombia, and this company found a good property, acquired a property, made some good moves, raised some money, and then they hit. And as you can see where they hit, stock moved up nicely. And as with the life cycle, it did peak out. So what is it about this that was going on? Well, in order for this to happen to your company or anybody else's company, you have to have news flow. So what I did is I plotted out every news event that that company put out from when it started. So you started off with a private placement, a new zone of mineralization. They acquired 100% of the property. Obviously things were looking good. They wanted the whole thing to themselves. Then they did a bought deal private placement, which means they had pretty strong support. Then they did increase to the private placements, and that always sounds good. Investor money is enthusiastic. Then PP closed, drilling starts, hired a consultant to do a 43-101. So we're now basically 5-6 months into the project. Things are looking good, so better set some options here. Then they did their quarterly MD&A, filed that, which would give the investors lots of information to work with. There was exploration updates. Then the assays were released, fairly decent. They did some metallurgical testing on the assays. That came out pretty good. And then they came out with better assays, and the stock took off. And they set more options. Then more assays. And by this point, the assays were starting to taper off a bit. Wasn't quite as strong as they thought. And the price started to pull back. Now, in that one where the price pulled back, I believe I have a slide up ahead that'll show you, but the bottom line is it went up and came back down and kept going down. Now, as I said before, if you're into the cheap shares pre-discovery hole and they make a discovery, it is absolutely amazing. And that happened to me. Back in 2005, 2006, the market was kind of crapping out. There wasn't much in the way of good stories. And I was in the helicopter industry then, and one of our clients had a company that I knew had a lot of properties in the Golden Triangle, and that he also had something out in Saskatchewan of no consequence. But I decided I would start selling off all the junk I had in my portfolio and just park it in his company until the market recovered, because his share price had pretty much bottomed out, and they had good projects, good management, and they could raise money. So yeah, I thought I'll buy it at 50 cents, and maybe in a year and a half I'll get 75 or 80. Well, that winter, their little property out in Saskatchewan hit uranium, which is what they were exploring for and drilling for, but they came up with a fantastic hole. It was February of 2006, and they got 6 meters of 2.27% U3O8. Now, 2.27, that is extremely high, because the competing suppliers of U3O8 in Kazakhstan are producing 0.1 to 0.3%. So this is extremely rich. It's in the Athabasca Basin, and that is known worldwide as the richest uranium deposits in the world. So go through to August, price is doing pretty good. Different news coming out, good news, not so good news, stretches where people get bored, people take profits. Then early 2008, it was getting some very good holes, consistently good holes. And there was no dusters. Everything was producing high-grade uranium assays. But in kind of early mid-2008, won't mention the company, but it's a brokerage firm, and they put out a real nasty research report about how there was no way there was going to be, I think it was 50,000 pounds of uranium was the estimate. And they said, nah, it ain't going to happen. So the price went down. Some people thought that they were crazy. So there was lots of trading, lots of activity. And you can see there above 2008, when the price is coming down, it gapped down at the point where they put that research report out. So I think it went down to around $1.20. And then there was lots of arguments about, no, that research report isn't right. They hired somebody to do the resource estimate, and the resource estimate came out and said, no, there's not 50,000 pounds of uranium there. Be lucky to get 30. Problem was the hole spacing. Their hole spacing was too wide to incorporate the whole deposit, so the resource estimate was only based on those holes and not what was in between them, which was pretty consistent with the fact that it was mineralized, but it was not being addressed. So all these arguments are going on online, and eventually the price started to stabilize and recover back up to about $2.67. Now, if you were to take that business cycle where it goes up and comes down, you can pretty much overlay it on there, where you can see you have the excitement phase. It comes down into kind of a trough where you're in that orphan period, going sideways at 267. And, is it safe to buy? Is it not safe to buy? So this is a news release. Hathor cutting through some high grades, and they actually got grades up to 68% U3O8. So that's when things started getting exciting again through 2008, 9, and 10. So this is what I was saying. You could overdraw that business cycle onto this. And what happened is they were sitting at 267, and Cameco decided they want to buy it out, and they made an all-cash offer to take it out at 375. And then Rio Tinto came back and said, no, we want it. We'll pay you $415. And then Cameco came back and said, no, we're going to get it. We'll give you $450. And Rio Tinto came back and said, nah, we're way bigger than you. We'll give you $470. So the deal did close at $470. Hathor ceased to exist. All the shareholders were paid out. But nobody actually knew that at 267, that you're going to get an immediate double within a few weeks. So it was a very exciting time, but this goes to show you, if you buy or accumulate shares during the orphan period, you're buying it at a very de-risked point. So this is a life cycle of Junior Explorer chart again. So you go up through that speculation phase, you come back down, and you hit that orphan period. So this is a time to saddle up and do some serious work on it, because it has shown that it has potential to be an economic discovery, but you don't know that yet. That's where the risk is. So if you're in that orphan saddle, the thing you need is a resource estimate. As we just mentioned, the orphan saddle represents an extraordinary opportunity of reduced risk for investing, but it includes risk nonetheless. So this is where it's up to the individual investor to do some serious work. The risk considerations you want to factor into your analysis are, what's the jurisdiction of this discovery? What kind of infrastructure do you have? Roads, power, ports? Is it an area that has indigenous issues to deal with? Like if you're in Peru or Colombia or Ecuador, sometimes you got certain villages that they don't want any development happening there. Or farther up where you're planning on developing, is there water supply for a major city down below? All these things come into play. Then there's the metallurgy. You got to solve the metallurgy to know what your costs are going to be. Are the costs of metallurgy going to be too difficult? Or is it just something that's going to cost more money, but the deposit is so good you're going to solve those problems? You're kind of looking at this on a serious sense because you had a resource estimate to work with. Now maybe you get a second updated resource estimate, and you look at that, is the deposit still open? Is it still growing? Is the resource estimate better? Have the grades changed? And then at some point they're going to go into preliminary economic assessment, and they'll be needing to use the numbers of the inferred, indicated, probable, proven, cut-off grades, and factor in all-in sustaining costs of operation if they can. And that way they can give you a report and say, hey, this is economic, and this is how much money we're going to need to put it in production, and let's go for all this. At which point you got to get involved in permitting. So now we're back to jurisdiction. Are you in an area where the permitting will go through? Has there been other mines go through the process and start development and production? The other thing is going to be, in the situation we're in the Golden Triangle, is what's the price of gold? Of course, copper and silver are important too, but basically the driving force is the price of gold. So is it on a flat trend, upward trend, or is it just got all kinds of negatives coming at it? And the way things are today, things are pretty positive for gold to maintain its price level or go higher. Then to be into development financings, whether a company is going to do their production capex funding over equity issues or using debt. So if you can get the answers to all that, you can really de-risk whether you're getting into a good investment, or you should hold back, or you should back up the truck, or whatever it is that fits your psychological profile. So this is going back to that one where I did tracked out all the news and everything else. That was a day chart that I showed you. This is I believe a monthly chart on each stock movement. But the bottom line is, it went up, it pulled back, it kind of had a bit of an orphan period, but it wasn't an orphan. It turns out there was no chance, there was not a resource estimate. As I said, this was in Colombia. They had a change in government, and the new government had a very heavy influence by the environmentalists. So a lot of people left Colombia at that time, and most of them haven't gone back, but a few have. But that's the kind of thing where jurisdiction and no resource estimate and no more assays, the whole story just goes away. The price goes down, and I thought this company was dead and gone, and when I looked it up, I was able to pull this chart. That company is still out there trading at 2.5 cents. I don't recommend it. Okay, we're back at the life cycle. Are you going to load up? If you are, you have to look at what's the potential news flow, because we've already seen that news flow is very important, and it's the news that is going to dictate whether this thing gets out of that orphan trough or not. So what I want to show you is here's one that's a couple of them that have gone up and peaked and are coming back through that phase where things less news, and you're looking to see if this is going to grow into being a substantial deposit and whether it has a chance. And is this in the orphan phase? Well, I happen to know this company quite well as I work for them. Top line is Teuton Resources. The green line is Tudor Gold, and the red line is American Creek. And all three of us are involved in the Treaty Creek deposit in the Golden Triangle. So the way I see it is we had the initial discovery phase, that peak of inflated expectations. Slowly speculators left. So speculators are selling. Well, there's something on the other side of a trade. It's called a buy. If somebody's selling, somebody has to be buying. So I think through this phase, serious, educated, knowledgeable investors have just been picking away and maintaining or building their positions, because some of them would have sold off on the way up and they can buy back in at this point. But regardless of that, it goes through the same psychological phase that every other company, business, whatever goes through. And it's just, it goes down into that orphan phase where everybody sits and waits to see what's going to happen. So, question mark, what is going to happen? This is back where we're going to be looking at all the risk considerations. So, jurisdiction, infrastructure, First Nations, these are all things that we know the answers to in the Golden Triangle. What we don't know is what the next resource estimate will have for us, and will it be good enough to take it into the PEA, which is anticipated. We're now looking at the Lassonde curve. This is the junior resource cycle curve, but somebody slapped the name Lassonde on it. Pierre Lassonde certainly deserves to have his name on something exciting for all the things he's done for the industry. So we're looking at the same curve, same phases and timelines, and the expectation and the disappointments, and then the orphan period. But in looking at what Treaty Creek is going through, as it came down into approaching the orphan period, we had the first resource estimate, and that brought quite a bit of confidence back to investors and shareholders. And then we've had the second resource estimate last year, which was even better. They raised the cutoff grade. They had more holes to apply to the resource estimate. But by raising the cutoff grade, you think you'd be cutting down the ounces. But the fact that they had more holes to add, we ended up with more ounces inferred, more ounces indicated, and at a higher cutoff grade. So everything is going along really nice. Price of gold is such that it should be economic at this point. If the metallurgy is right, who knows? We'll find that out, but that's the kind of information we're looking for. We have another resource estimate coming out, then followed by a PEA, hopefully. So those are the kind of things you can kind of plot as your potential news coming forward, because any movement is going to be news driven. So there is risk, but the assumptions are that things are going in the right direction and looking good. So if you're holding shares in Tudor Gold or American Creek or Teuton Resources, you should be reasonably comfortable that this is the baseline price. So the other thing is, I'm in the orphan phase. How do I figure out what the price should be? There are things that you know, and I've built this chart over a year ago and been following it. It is something that everybody can build. It's just a spreadsheet with a couple of formulas. The information you need to do this is how many ounces are in the ground. We can get that idea from the indicated and inferred. What's the in situ price value of that gold in the ground? We do not know that. That is the highly speculative item that we have to come to terms with. And that is where you put yourself at risk if you put the wrong number in. Treaty Creek's total value will be a factor of ounces and in situ value. So I put a formula in there, and it'll take first line, multiply by the second line, and give me a value. Now we come to where it says 20% Teuton. That's because Teuton owns 20% of Treaty Creek asset. If it was Tudor Gold, it would be 60%. If it was American Creek, it would be 20%. Because that's the way it is, 60, 20, 20. So we know that we're going to have 20% of the value. The next thing over is the fully diluted shares. So at this time, Teuton has 57 million shares out, and I put a formula in there that divides 20% Teuton value by that, and it gives us, at the $10 in situ price, gives us a price of 70 cents a share US or 94 cents Canadian. So, what do we do about in situ price? And for those that are still watching this presentation, this is where you got to get off the couch and help us out in the comment section, is do some research trying to find out how to calculate the in situ price. Cipher Research put out a report. They're apparently coming out with an updated one pretty soon. They'll let me know and give me a copy, but they plotted out the transactions of companies being bought out or taken over where the price, share price, and the gold price was related to the ounces in the ground. This is basically price of gold in the ground. So you can see some consistencies in there in the lower band with some anomalous numbers up higher, and then the odd one that's just an outlier for whatever reason. Might have been extremely high grade, easy to get to, whatever it was. But overall, they were coming up with prices in the ground that were consistent, and they represented actual transactions. So they were seeing, you'd see prices from $30 to $80 per ounce in the ground. This is one of the news releases out of Tudor, where they said they had an indicated mineral resource of 23 million and an inferred resource of 7 million. So that's 30 million ounces. Now, if you look at the chart again, we're starting at 20 million ounces, and then 25, and then 30. And these are numbers that you put in, not I put in. This is just numbers you're working with. You can do this with any company that goes through the phase of discovery, pulls back, and hits the orphan stage. The things that you need is you need the number of shares that are outstanding. You need the estimated size of the deposit in millions of ounces, and you need that to come from a resource estimate, because that's the only people that are qualified to give you that number that you could rely on to use in making a spreadsheet. So if you want to build your own spreadsheet, this is based on the one you were just looking at. You can go back and look at it. You can go forward, open a spreadsheet, and you can start putting this in. So in the first one, which would be C5, you got ounces in the ground. Take that from the resource estimate. You can be conservative, or you can be a little bit liberal. You can use indicated, or you can use inferred, or you can use two together. The in situ price, let's just leave that blank for now. Then you put in total value of the deposit. The formula is equals production bracket C5 comma D5 bracket. That is the formula you will need in there. Then you can go over to the next one. Percent of deposit you can put equals quotient bracket E5 comma 5. The comma 5, that 5 is representing 20%. So you go to the next one, shares outstanding, check it out in SEDAR or company reports and find the amount of shares that are outstanding, put that in there. And then you put the formula equals F5 slash G5. And that will take the numbers in those columns and give you a share price. And then you can go for market cap equals sum product bracket F5 comma G5 bracket. If you put those formulas in, you can go back and check my numbers. You can do one on American Creek. You can do one on Tudor Gold, or you can do one on any stock that has gone through that cycle, come to the orphan period, has given you a resource estimate to work with, and then the thing you have to do is come up with that in situ price, because that is what is going to be the trigger on really giving you the values you want, or the values that you would like to see are the potential gain that you could be making if the price goes forward, or if the buyout goes forward. So at 20 million ounces, $10 in situ price, which, well, I said I'd be aggressive, it's extremely low. But at 20 million ounces and $10, you would have $200 million in value there, of which 20% for Teuton or American Creek would be $40 million. We got our 57 million shares out, so that gives us a price of 70 US or 94 Canadian, and that's what those formulas were that I just gave you. So we're talking about 30 million ounces inferred and indicated, and when you're starting to get to that big a deposit, there's no way it's going for $10. So if it is that big a deposit and the metallurgy is good and the PEA comes through, then we're really going to start to understand what we're sitting on. At $30 might be conservative. I've got 120 at the bottom. That would be extremely high, but it has happened with some of the deposits out there. This is the way you can build a sheet to better inform yourself of what the opportunities are, where you might want to step in, where you might want to sell. But it can be figured out. And the nice thing about this is you're not buying shares in 40 different companies hoping one makes a discovery. This is where the company's already gone through that phase, the discovery's been made, you've come back to the disappointment, it's tailed off in the orphan period, and here's the opportunity for you to build yourself a model that can help you understand it. And you can go in the comment sections of this and tell us what you're finding. Do you find something out exciting about who's figuring out how to do in situ valuations? All those things would help. And you can try this chart, and if it doesn't work, put it in there, and we'll see if we can help you fix it up. Anyways, that is an opportunity if you're interested to get more involved in actually figuring out what kind of opportunities you have at much less risk than the pure speculation side. So put your comments in. Appreciate you watching, and share what you learn. And we'd be glad to try and help you out with any of the questions down below. Thank you.